What if I told you some of the world's most stable companies are trading at a discount right now? The key, their low PE ratios. I found 5 household name stocks with some of the lowest PE ratios for November 2025, meaning they could be seriously undervalued. We'll cover a medical device innovator, a semiconductor leader making waves in AI, a pharmaceutical giant with a blockbuster pipeline, and 2 telecom powerhouses with strong dividends. These companies could be the foundation of a solid portfolio, and they are on sale. If you want to get ahead and discover which stocks could be poised for a comeback, you're in the right place. Smash that like button and subscribe for more investing updates. Let's dive in. First up is Abbott Laboratories, ticker ABT, a healthcare giant whose products are everywhere, from hospitals to your medicine cabinet. Abbott Laboratories is trading at about 15.5 times earnings with a market cap near $216 billion. This diversified healthcare powerhouse is still growing, strong margins, nearly 18% net income growth, and hot demand for its continuous glucose monitors and cardiovascular devices. The market's giving it a haircut, roughly a 38% discount to its 3-year average multiple, mostly because of supply chain hiccups and slower international traction. Watch for smoother supply chains or stronger overseas sales to flip the sentiment. Abbott's strength is its diversified portfolio: medical devices, diagnostics, nutrition, and pharmaceuticals. If one segment slows, others pick up the slack. Their financials are impressive, strong profit margins, and consistent, profitable growth. Despite this, ABT is trading at a discount to its historical valuation and peers, thanks to short-term headwinds. For long-term investors, that's a rare opportunity. The demand for Abbott's products is only growing, driven by an aging population and increased focus on health. Their Freestyle Libre diabetes system and cardiovascular devices are industry leaders, and Abbott invests heavily in R&D to stay ahead. Their nutrition brands, like Ensure and Similac, are household names with strong, stable demand. This built-in diversification and brand loyalty make Abbott resilient, even in tough markets. Right now, the market is offering a blue-chip healthcare leader at a bargain price. As post-pandemic headwinds fade, the market will likely recognize Abbott's core strengths, potentially leading to a higher valuation. Abbott is also a dividend aristocrat, increasing its dividend every year, a sign of financial health and shareholder commitment. The key takeaway: Abbott's current price doesn't reflect its quality or growth prospects. You get exposure to devices, diagnostics, nutrition, and pharma, all in one stock. Healthcare spending is non-discretionary, adding resilience to your portfolio. The risk-reward profile is attractive. Strong fundamentals limit downside, while upside potential is significant as sentiment shifts. Abbott is a stock you can hold for the long term, collecting a growing dividend while waiting for the market to catch up. It's a classic value play hiding in plain sight. In summary, Abbott's diversified business, strong margins, and reliable dividend make it a compelling buy at today's valuation. Keep ABT on your watch list for November 2025. The market's short-term focus is your long-term opportunity. Don't overlook this healthcare titan. The fundamentals are strong, and the price is right. For patient investors, this could be a cornerstone holding. Remember, quality companies on sale don't last forever. Abbott's story is about resilience, innovation, and value. That's why it's first on our list. Before we move to the next undervalued giant, if you want to learn how to find more stocks like this, check out the Value Stocks Investing Master Course, link in the description. Next up is Qualcomm, ticker QCOM, the company powering your smartphone and now making a major push into AI. Qualcomm sits around 17.3 times earnings and a roughly $193 billion market cap. It's no longer just smartphone chips. Recent moves into AI accelerator chips for data centers have traders excited and even sparked an 11% pop after the announcement. With healthy margins and a modest dividend, the upside depends on how fast Qualcomm can turn that data center story into real revenue and take some heat off smartphone cyclicality. Qualcomm's core business is mobile chips and 5G technology, but it's rapidly expanding into automotive IoT and on-device AI. Their patent portfolio generates high-margin licensing revenue from nearly every smartphone sold worldwide, creating stable cash flow. What's exciting now is their move into automotive chips and AI. Modern cars and devices need powerful, efficient chips, and Qualcomm is leading the charge. Their Snapdragon chips are being designed for on-device AI, enabling faster, more private, and efficient applications. The market is starting to notice, especially with the launch of their Snapdragon X Elite chip for PCs, which could disrupt the market and open new revenue streams. Despite this, Qualcomm's PE ratio remains low compared to other AI-focused semiconductor companies. The market still sees Qualcomm as a legacy mobile supplier, missing its transformation into a diversified tech leader. Financially, Qualcomm is strong, High margins, robust free cash flow, and a healthy dividend. Growth drivers include global 5G rollout, automotive tech, IoT, and the rise of on-device AI. The risk is competition and the cyclical nature of semiconductors, but Qualcomm's technology and patents provide a strong moat. As revenue from automotive and AI grows, the market could re-rate the stock, offering significant upside. You're getting exposure to the AI boom at a value price, not a hype premium. While others chase the same AI names, Qualcomm is quietly building the infrastructure for the next wave of intelligent devices. For investors willing to look deeper, this is where real value lies. Qualcomm is a tech giant trading at a value price. The fundamentals are solid, and the growth story is just beginning. Don't overlook this AI chip powerhouse. It's a smart way to play the future of tech, without overpaying. Keep QCOM on your radar for 2025. Let's move on to our next undervalued opportunity. Our third pick is AstraZeneca, ticker AZN, a global pharma leader making huge strides in oncology and specialty care. AstraZeneca is trading at a bargain basement 7.7 times earnings with a market cap close to $192 billion. The oncology franchise is firing over 100% net income growth, but the stock is cheap because investors worry about patent cliffs and generics. If the pipeline keeps delivering and emerging market sales accelerate, that multiple could re-rate, but expect some near-term volatility. AstraZeneca has transformed its pipeline, delivering blockbuster drugs in cancer, cardiovascular, and respiratory diseases. Their oncology portfolio, 𝗗𝗟𝗏𝗧 drives significant growth and revenue. The company consistently delivers profitable growth, not just top-line expansion. So why the low PE? The market fears patent expirations and competition, but AstraZeneca's pipeline is one of the strongest in the industry. Their acquisition of Alexion Pharmaceuticals expanded their reach into rare diseases, adding long product cycles and less competition. The market often over-penalizes for future patent cliffs, creating opportunity for investors who believe in AstraZeneca's innovation. As a UK-based company, AZN sometimes trades at a discount to US peers, another inefficiency for global investors to exploit. Their oncology franchise is deep and diversified, including cutting-edge antibody-drug conjugates. They also excel at expanding existing drugs into new indications, like Farxiga's move from diabetes to heart and kidney disease. The market is in show-me mode, waiting for more clinical trial wins and approvals. The low PE gives you a margin of safety. You're buying a profitable business and getting pipeline potential for free. AstraZeneca pays a solid dividend, showing management's confidence in future cash flow. Risks include clinical trial failures and competition, but their broad pipeline means they don't need every drug to succeed. A few more blockbusters could drive significant growth. In summary, AstraZeneca offers best-in-class growth, a dominant oncology position, and a packed pipeline, all at a value price. The market's fears may be overdone, and the upside is real if the pipeline delivers. For investors seeking innovation at a discount, AZN is a compelling choice. Keep AstraZeneca on your watch list. Shifting gears to telecom, let's talk about AT&T, ticker T, a company with a massive dividend and a new focused strategy. AT&T trades at about 8.2 times earnings and yields roughly 4.4%. The carrier still posts reasonable margins and positive subscriber trends, but heavy capital needs for 5G and stiff pricing competition have the market nervous about growth. For income investors, the key question is whether free cash flow can keep the dividend comfortable. Stronger ARPU and sustained cash generation are the things to watch. After spinning off its media assets, AT&T is now a pure-play telecom, providing wireless and fiber services to millions. This is a utility-like business. People need connectivity, making revenue stable and predictable. Despite a past dividend cut, AT&T's yield remains among the highest for large-cap stocks, often 6-7% or more. The big question, is the dividend safe? With a leaner business and reduced debt, free cash flow now comfortably covers the payout. AT&T trades at a rock-bottom PE ratio as if it's in terminal decline, but the business is adding wireless and fiber subscribers, and demand for connectivity keeps rising. Heavy investment in 5G and fiber is expensive, but once built, these networks are valuable, providing faster, more reliable service and sticky customers. The market's skepticism stems from past missteps and sector headwinds, but at this price, the downside seems limited. You're buying a stable, cash-generating business with a huge customer base, at a deep discount, and getting paid a generous dividend to wait. Growth will be slow and steady, not explosive, but the high yield supercharges your returns. The key for 2025, watch debt reduction and subscriber growth. Progress here could trigger a re-rating. Think of AT&T as a utility with a growth angle, trading cheaper than many no-growth utilities. Risks include competition and rising interest rates, but management is focused on efficiency and locking in fixed-rate debt. Ultimately, AT&T is a contrarian bet that the market is too pessimistic. For income seekers and value investors, it's a compelling idea. Keep AT&T on your radar for 2025. Let's look at another telecom giant with dividend royalty status. Our final stock is Verizon, ticker VZ, AT&T's biggest rival and a dividend powerhouse in its own right. Verizon comes in at around 9.4 times earnings with a market cap near $169 billion and a very juicy yield about 6.9%. Recent quarters showed profit strength, helped by broadband gains, though top-line growth is sluggish. The story here is stable cash flow and a long dividend track record, but the market is pricing in limited growth in the mature telecom space. Broadband upside and an improving revenue mix would be the catalyst to change that view. Verizon is the slow and steady winner, known for the most reliable network and industry-leading profit margins. Their loyal customer base and premium brand are major assets. Like AT&T, the main attraction is the dividend. Verizon has a long history of paying and raising it, making it a favorite for income investors. Verizon trades at a low single-digit PE, as the market prices in little to no growth due to sector headwinds. But Verizon's balance sheet is stronger than AT&T's. They avoided risky media acquisitions and have more financial flexibility. Their growth strategy focuses on 5G leadership, expanding Fios fiber, and rolling out 5G home internet to compete with cable. They're also targeting business and enterprise customers with private 5G networks, a new potentially lucrative market. The main concern: slow growth in consumer wireless and fierce competition, especially from T-Mobile. The market worries Verizon is a melting ice cube, but the company is expanding into broadband and enterprise to offset this. At today's valuation, you don't need heroic growth for the stock to work, just stability and modest gains. The high dividend yield provides a buffer while you wait for growth initiatives to pay off. For conservative income-oriented investors, Verizon is a blue chip at a cyclical low. It's a bet on stability, execution, and the long-term value of a premium network. Keep Verizon on your watch list for 2025. There you have it. 5 undervalued companies with low PE ratios heading into November 2025. We covered a healthcare leader, a tech innovator, a pharma powerhouse, and 2 telecom titans with big dividends. Each has a compelling story, and current market pessimism could be your opportunity. Investing is about buying quality when it's out of favor. Want more stock tips and analysis? Join the StocksGalore Patreon, link in the description. Which of these stocks do you think has the most upside for 2025? Let me know in the comments. Like, subscribe, and stay tuned for the next investing update. Thanks for watching. See you next time.